Welcome to one of the 401k Academy webinar series for 2011. This is something we do almost weekly for the last couple of months. It's presented by the Academy, and the Academy, of course, is really a device of Plan Design Consultants, Inc., which is a third-party administrator in San Mateo. We have been around for a mere 36 years, and our goal in life is to help advisors secure and win new plans, and then to administer those plans very competently, and to help everybody be successful. The session today is called Creative Design or Creative 401k Design. I'm Paul Carlson. I've got my phone number there, 650-425-7912. That's my direct dial, and you've also got my email. So if this presentation creates any questions, or if there's something you'd like to follow up on and get more clarification, let me know. I will have you muted. We probably won't take any questions because our idea here is to get you in and get you out in the 30 minutes. Absolutely. Let's start off by reviewing, when we talk about design, the 2012 limitations. You've probably all seen them in the financial press. You can find them at the 401k Academy website at www.401kacademy.com. Click on the Advisor Materials tab, and then click on the Retirement Plans Limitations chart. And by the way, we're trying to record this webinar, and we'll post it on that website. You'll be able to retrieve it kind of on demand. What are the limits for 2012? Well, salary deferrals can be $17,000. That's up from $16,500. The make-up deferral for somebody over age 50 by the last day of 2012 would be $5,500. So if somebody is 50 years or more, anytime during 2012, then they can do the total of $22,500 in salary deferral. That would be the same number for a 403B. The annual additions limit for the year has been raised from $49,000 to $50,000. Of course, if you're doing something in a 401k, then because you can do the makeup deferral, then you can actually get as high as $55,500 as allocations to your account. That's from salary deferrals, matching contributions, safe harbor contributions, profit sharing contributions, forfeiture additions, and anything added to your account. If you have a client or a prospect who wants to get beyond the $55,500, then of course you can go to a defined benefit plan. You could either do a standalone defined benefit plan, or you could do a combination 401k cash balance combo, for example. And there you might be able to get a principal of your firm up to as much as $180,000 to $200,000 to $250,000 of contributions and deductions on their behalf. The amount of money that we can count for purposes of retirement plans for 2012 has been raised from $245,000 to $250,000. So we don't care if somebody makes $1 million. For plan purposes, we can only count $250,000. Your simple limit would be $11,500, and if you're over age 50, that would be $14,000 because it's a $2,500 makeup contribution. Social Security wage base has gone to $110,100. Sometimes that comes into play if we've designed a plan using what we call permitted disparity. In the old days, we used to call it Social Security integration, but now it's called permitted disparity. So there's your limits for this next upcoming year. At the beginning of every year, when the limits are announced, I take out one of my business cards and I put basically these notes on a business card because I refer to it all year long, at least until I get it memorized at my old age. Excuse me just a second. So if I'm trying to max somebody out and they're over age 50, I know the limit is $55,500. Well, if I'm going to do some sort of a plan, maybe a safe harbor plan, where they can do salary deferrals, then I know that the salary deferral limit is $22,500. Since the limit's 55.5 and the deferrals is only 22.5, then that means there's some additional amount of $33,000 that I probably would want to allocate as a profit sharing contribution to that person in order to get to the limit. Well, if the compensation limit for 2012 is $250,000, then that $33,000 represents a 13.2% profit sharing contribution. And if I'm doing a cross-tested plan, meaning safe harbor cross-tested plan, meaning that I want to minimize my contributions for the staff, then I have a 1/3 rule, which means I have to give them at least 1/3 of what I give to the HCEs, although that 1/3 does not need to exceed 5%. So anyway, this is what I put on a business card. I always know that if I'm trying to design something max, I'm going to give somebody a plan where they can do 13.2% as a profit sharing, do their $22,500 as salary deferrals, and get up to the $55,500. And it will only cost them 4.42% for the staff. Here's another example. Owner making $250 or more, staff person making $50. I'm going to put in a 4.4% profit sharing for the staff. I'm actually going to do that in a special way. I'm going to do a 3% safe harbor plus a 1.4% extra profit sharing. The safe harbor cannot have an end of the year requirement, and it has to be 100% vested. The extra profit sharing can have a vested schedule. So anyway, if I have somebody making $50,000, I'm going to give them 4.4% of pay, which is $2,200. And then for my owner, I'm going to be able to do 3 times that, which is going to be 13.2. The allowable salary deferral for the owner, again, is 22.5, so the total for the owner is 55.5. The total cost in this particular one employee scenario is $2,200, so the owner is going to get $55,500 out of a total of $57,500, which is 96%. If you want to compare or contrast that to giving this same owner an SEP, to get the owner to the $50,000 SEP contribution limit, which is probably 20% of the $250,000, then you got to do a 20% of pay for the employee. That's not entirely true. You can use permitted disparity for an SEP. I just never see one where anybody's done that. So obviously a 401k cross-tested is going to be far more effective than a simple or an SEP. When does it work? So again, you max out at 55.5 at a cost of maybe 4.4% for your staff. That is assuming we have the right demographic. Well, when does a safe harbor cross-tested plan work? It works when my business owners, whether it's 1, 2, or 3 or 4 people, or maybe it's a law firm where there's 100 partners, but it works where generally my HCEs, my principals, are somewhat older than at least a portion of the support staff. Not all of the support staff, but a portion of the support staff. Well, obviously, when you talk about professional firms, it takes people a while to get their degrees and their credentials and work their way up in different firms and become owners. So this is a very effective design for law firms, CPA firms, engineers, architects, doctors groups, literally anybody where the business owners are somewhat older than at least some of the staff. Now, this is called creative 401k design. There's nothing overly creative about what we call new comparability. It's been around for so long, we really shouldn't refer to it as new comparability anymore. So I tend to refer to it as a cross-tested plan or a plan that's got allocation groups, separate allocation groups. Now, this little icon in the bottom right is to remind me to do a poll. And so I'm going to try to launch a poll for you. And you're going to answer it on the screen. And so if you go ahead and just take a second to answer this question, the question is, what's the deadline for a new safe harbor 401k plan? So you got a prospect or you got a client, they don't have a plan at all, or maybe they have profit sharing only and they want to go to a 401k. So question of what is the deadline for setting up a safe harbor 401k plan. Looks like you've all voted. So I'll close the poll and I'll share results with you. And ladies and gentlemen, you're all wrong. So let me hide the poll. 50% of you said 1-1. I think what you're thinking there is if it's an existing 401k plan, when can you convert it to a safe harbor? And that would be true if it's a calendar year plan. You have to do it by the beginning of the year. Let me get back to the slideshows. I had a prior presentation where I forgot to get back to slideshows, so people just saw that poll result for the rest of the 10 minutes. So anyway, the limit or the deadline for setting up a new safe harbor 401k plan is October the 1st. The IRS or government wants you to, if you're going to have a plan, to have it long enough so that your rank and file can take advantage of it and earn some sort of a matching contribution or something, and not just have it be something where the owners can afford to do it in the last couple of paychecks, but nobody else can. So October 1st is your deadline. If you have no plan at all, or if you have a profit sharing plan and you want to amend it into a 401k. If you have an existing 401k plan, then you can only convert it to a safe harbor first day of the next year. So you cannot convert an existing plan. All right, so anyway, it's obviously November, so it's too late to set up a cross-tested safe harbor 401k for this year or to convert any kind of a plan. So what can we do? Well, it's not too late to create a cross-tested profit-sharing plan. So maybe they have a 401k plan, but it's not working out very well. Somebody finally shows them, or you show them with our help, that they could do much more effectively with a cross-tested allocation group type of a plan. Well, we can set up a cross-tested profit-sharing plan. The deadline is midnight, December 31st. This has to be signed by that time to be effective for the whole year. And so that gives us the ability to do something. We have a client right now that they definitely wanted a plan. They wanted a safe harbor cross-tested for 2011, but we didn't get introduced to them until the middle of October. So what I did was I set them up with a profit sharing. Actually, I gave them a 401k document. But I made the 401k and the safe harbor provisions effective January 1st of 2012. But I still had the profit sharing provisions effective retroactively to January 1st of 2011. And in that particular case, by giving a 5% safe harbor gateway to about 5 people, I was able to do over a 30% contribution for the business owner. So there is still time if you have closely held or the right kind of prospects, and cross-testing would make sense. Just because you're going to eventually go toward a safe harbor cross-test in 401k, that doesn't mean we can't start up the safe harbor part of it right now. And there is no 25% limit. There's an overall 25% business deduction limit. But if I've got some people only getting the 5% gateway, and then I got my business owner getting 30.62%, then there's nothing wrong with that as long as the total is within 25%. This is a real-world situation. We had an advisor bring us a case. It's with XYZ record keeper right now. The advisor has convinced them to switch to a different record keeper. And the client has got a lot of really well-paid people, and they were introduced to the allocation groups. We looked in their plan document, and lo and behold, they had a plan document that allowed for profit sharing, but it did not require that somebody be there on the last day of the year. If I have a plan document, and that would be all standardized prototypes. So if you've got a client that's with paychecks and they've used their standardized prototype, and if we're already beyond 1,000 hours into the year, then we can't change the rules in the middle of the year to go to cross-testing. Well, what's the solution? We also, in this particular case, there's going to be great difficulty getting the current vendor to amend their plan to cross-test it. And again, too late in that case anyway. And then it would be complicated for them to deal with that cross-tested profit-sharing allocation. So what do you do? What do you do? Well, a little creativity. We just we install a standalone cross-tested profit-sharing plan for 2011. That leaves the 401k plan completely alone so that the existing record-keeping vendor can be responsible for administering it for 2011. Too late to bring somebody else in to administer it for 2011. The assets won't even be transferred until next year. And then all we'll do is simply deal with the profit sharing by itself for this 1 year. And then when we move to the new vendor and restate the document, we'll merge the two plans back together. And so everybody's happy, everybody can do their job. Hopefully, you'll get some feeling through this webinar that it might be good to involve a TPA in your practice, in that TPAs might have a lot of creative ideas to bring to bear to your plans, whereas perhaps maybe the bundled providers have never thought about it. Excuse me just a second. So the scenario. Another scenario. I've got lots of support staff. They're of the type that they just cannot afford to do salary deferrals. And then I've got a young business owner who's very well paid because Dad started the business some time ago, and now they've taken over the business. So they're in their mid-30s or something. So are their employees. So in that situation where my business owner I'm trying to favor is not older than enough of the staff, then cross-testing will not work. Well, now what am I going to do? Am I going to do a pro rata profit-sharing allocation and give everybody the same thing that I'm giving the business owner? Am I going to use permitted disparity that'll give me a little bit of difference? But those are not very effective, not very desirable. So what might we do? Well, what we might do is what I call double down or a double match. What it is and again, we'd have to do this for next year. It's too late to do it for this year. But we put in a safe harbor plan with a match. And so because it's going to be a safe harbor, then my young owner can do $17,000 of salary deferrals without worrying about what the employees do. And you got a group of employees here who aren't going to do much or maybe anything because they're making $20,000, $30,000 a year and they can't afford it. And besides that, we're going to kind of roll this out in what I call stealth mode. Now, what is stealth mode? We're not going to make a big hoopla out of it. What the owner's hoping for here is to shelter money or for the key people without having a lot of expense for the matching contribution. And yes, there are rules and regulations about what you must disclose to the participants. And certainly having a plan versus having no plan is to the benefit of the participants. And so if you had a situation where too many people would make deferrals and get too much of a matching contribution from the employer, then the option is they'll have no plan. So having a plan in stealth mode is better than having no plan because because those who are aware enough to see what's going on can take advantage of it and benefit from it. So anyway, what we do is we have a what's called an enhanced safe harbor. Instead of doing the normal safe harbor, we do 100% of the first 6% of salary deferrals as a match. So for my owner making $250, that would be 6% of $250 is $15,000. And then I'm allowed, even though that's my safe harbor, I'm actually allowed to make additional discretionary matching contributions. And what you can do is you can do matching contributions over and above the safe harbor. Give me just a second. I got a tickle in my throat, so I got to keep drinking a little hot tea here. So you can go over and above the safe harbor, but only to a certain extent. You can only base your additional discretionary match on up to 6% of salary deferrals, 6% of pay, and it cannot exceed 4%. So we put in a formula that says we're going to contribute 66 2/3% of up to 6%. And it's discretionary. The employer can do it or not do it depending on what kind of a year they're having. But let's assume it's a good year. They look at how many participants have taken advantage of the plan for the year, and not many have. And so they see that there'd be a reasonable cost there. And so they decide to go ahead and make the discretionary match. So they do a 4% for that owner. So when I'm all done, I've got $42,000 being put away for the owner between their salary deferrals and their double dip match, which is pretty effective. So get into the next topic. I'm gonna do another poll. It's also to make sure you guys are paying attention. So answer this question, if you will, with a basic safe harbor match, not an enhanced match. What is the match for a participant who's doing 5% of pay? So what is the match for a participant who's doing 5% of pay? Is the safe harbor match turn out to be 3%, 4%, or 5%? All right. You guys do know that. You all answered it, well, spoke too soon. Somebody did answer it incorrectly. So what's the answer? Let me hide that thing so we can get back to our PowerPoint. Your basic safe harbor match is 100% of the first 3% plus 50% of the next 2%. So that translates, for example, if somebody does a 3% deferral, they get a 3% match, 100% of the first 3. If they do 5% of the deferrals, then the answer you were looking for was a 4% match. You might have confused the 3% answer. That's the 3% profit sharing approach, where instead of a match, you're giving a 3% employer discretionary safe harbor to everybody, whether they do deferrals or not. So if we're talking about the basic safe harbor match, it's 100% of the first 3 plus 50% of the next 2. And it's always got to be 100% best. Well, creative design. You've heard about it. You've probably heard the term. You've maybe never done one yet. So let me suggest to you that you consider presenting to your new prospect who either already has a basic safe harbor match or who's setting up a new plan and wants to use a safe harbor, but wants to use a matching type because not a lot of their employees are going to do deferrals, but it turns out to be cheaper. If you do the QACA, sound like I'm at Aflac Duck, but if you do the QACA, the Qualified Automatic Contribution Arrangement, then you can save money as far as the match. Now, what is it? It's a safe harbor match combined with automatic enrollment. All right, I've got a firm in Belmont. I got a firm in San Jose. The firm's got 15 people. They're all in that office. They all show up every day to get in their trucks or go out and do their work or everything. So what I do is I go ahead and create an automatic enrollment 401k. How do I keep that from being a big hassle, which it could be? I just simply render it moot by getting everybody to turn in a form. The minute they turn in a form, they're no longer subject to automatic enrollment. So if they turn in a form saying, no, thank you, I don't want to participate. Now, if you do that automatic enrollment, then your safe harbor is cheaper, and you can have a vesting schedule. So 1 year service, 0% vested, 2 years, 100% vested. So here's a comparison. You're at the 2% deferral limit. Your basic safe harbor would be 2%. Your QACA would be 1.5%. So you would have saved 0.5% on everybody at that level. In the 3% salary deferral level, your basic safe harbor is 3. Your QACA is 2. And so at most levels, you're going to save a full 1% as far as what the cost of the safe harbor is. Most employers are not doing the safe harbor because they really want to. They just don't want to have refunds for their key people. And so they're willing to do it, even though they'd like the cost to be less. Well, if you're a good advisor and you know what you're doing, you can show them how to make the cost less. And so, again, you can look at the chart yourself. I've generally got savings, of 0.5% to 1%. That could be substantial across a large payroll. So look at the QACA. I'm doing 2 brand new plans right now where the advisor gave us the go-ahead yesterday, and in both cases, he convinced them to do a QACA. And why not? They're only 5- and 6-person firms, so the automatic enrollment is a slam dunk. Everybody will enroll, so it's moot, and then we'll have the less expensive safe harbor, and now the owner can max out. Just a few other creative designs, although we got only 2 more minutes left for the seminar or webinar. But obviously, if you want to get beyond the $55,500 limit, then we can help you look at a cash balance 401k combo plan, where it can be very effective when you combine the cash balance with the 401k, because it eliminates the problem of the older employees costing you a fortune in a defined benefit plan. Another creative design that is overlooked often is what's called a top paid group election. In our documents, there's a little box that we check off that says, are we going to alter the definition of what is a highly compensated employee? So I've got a prospect right now that we're installing. They have about 80 employees, and about 50 of those employees make enough money that they would be top paid, that they would be highly compensated employees. If somebody makes over $110,000 in the prior year, then they're a highly compensated employee. Although, with 80 employees, if I do the top paid group election, I only have to count the top 20%. So I take my people ranked based on their pay in the prior year, and I count down the top 20%. So on 80 people, that would be the top 16. So those 16 are my HCEs, and they're the ones subject to any limits. And then all these other people who would normally be HCEs have a free pass. They can do whatever they want to. And besides, they make really good money, so they're going to do a lot. So they end up improving the ADP test for everybody else, even if I don't have a safe harbor. Another creative design that's not often used, and certainly not used by the bundled vendors or by the payroll providers, is the 3% profit sharing safe harbor. That they use, but the way they do it is not ideal. What your typical vendor will do is the 3% profit sharing safe harbor becomes what we call a will. You issue a notice 30 days before the beginning of the plan year saying, we will make a 3% safe harbor next year. What we think you probably ought to consider doing is, in our document, which is more flexible, we have a provision that says you can issue what's called a maybe notice. So for our calendar year plans, we just issued a lot of maybe notices for 2012, and what we're saying is we may make the 3% safe harbor. We'll let you know by the end of November 2012 if we're going to do it or not. What I just did was created flexibility. If that employer ends up deciding for some reason not to make the safe harbor, they don't have to. If they have a business downturn and they just can't afford it, and the HCEs are not doing any salary deferrals anyway, then they can just issue a notice, say, well, we're not in a position to do it. So the 3% with a maybe notice is definitely something to consider for your client. Another thing that people often overlook and don't take into account is the fact that you can do class exclusion. The rule says that if you cover 100% of your HCEs, then you have to cover 70% of your non-HCEs. So you could carve out a group of people that maybe are well-paid salesmen or something and not cover them, do a class exclusion for them. Furthermore, let's suppose it's a second-generation firm. Dad's still kind of hanging around the edges, taking a little bit of pay, but he's accumulated all of his money, and he's all set, and he doesn't really need to be in the 401k plan. So you do a class exclusion, and you take out Dad, who's an HCE, and now you're covering son or daughter, and so now you've only covered 50% of the HCEs. Now you only need to cover 70% of 50%, which is 35% of your non-HCEs. So that means you could exclude plan and not having a plan. So class exclusions are something that a good CPA can work with you on and apply to the right situation. Well, I'm 2 minutes over. Of course, I started 2 minutes late, but I appreciate your time. I certainly, we look forward to helping you on any prospects. We're actually in a position to get multiple proposals for you, analyze those proposals, do a cost comparison, do a really impressive features comparison for your prospects. Actually, Tariq or Chad or JD can all help you with that, do that grunt work for you, get it all nice and presentable, and even go to the point of sale with you to present it to the committee or to whatever. And you know, if you want to make good money in this business, you'll be looking for the $3 million, $5 million, $10 million, $20 million plans, not the little startups that some of my designs are related to. So here's your names and phone numbers and emails for our consultants and vendor analysts. They're really, really good at their jobs. We appreciate your attending today, and we'll look forward to having you attend some future webinars. This will be recorded and on our website. So if you want some other associates to see it, or if the concepts were a little bit quick, then feel free to see it later. Thank you all very much. Have a wonderful day.